Hello, everyone. This is Eric Spotswood with Prosperity Home Mortgage. I get asked a lot today about what's going on in the market. What should we expect? What about this bubble bursting? What about this, terrible rate situation that we're in? So I understand the one thing that I always want to do is I never want to talk anybody into doing something. What I want to do is explain some of the facts and some of what we're seeing in the market because I think the best thing to do is make sure that you're really well informed and you understand the market so you're not basing your decision based on the fear about where things could potentially be. So I wanted to talk a little bit about some things that I'm seeing statistically in the market today. So when people are worried about the bubble bursting, when they talk about the bubble bursting, inevitably they're usually talking about this. So they're talking about, or this, sorry, they're talking about this huge bar here where you talk about that drop that happened in 2008. Well, the reason I want to show this graph is to show you just how big of an anomaly 2008 was. Even though there have been market crashes and other recessions that have happened over time, what you see is actually 3 of the last 5 times we went into a recession, home prices appreciate. And if you took out 2008, look at 1991, they only actually went down about 1.9%. So it really makes 2008 a gigantic anomaly. So what happened in 2008 that made that change so dramatic? The short answer is foreclosures. There was a massive wave of foreclosures that hit the market and it greatly impacted home values, driving the values down dramatically. So what are some of the things that I saw in 2008 that I'm just not seeing in the market today? Well, one of the biggest things that we saw is inventory. In lending or in real estate, they look at how quickly homes are selling in the market. And they said if no other homes hit the market based on the current rate of sales, how many months would it take to sell everything that's out there? A normal market is one that would take about 3 to 6 months to be able to sell off all the inventory. So what you see, these little gray bars are months of inventory in the market. So what you see there in 2008 is there was about 12 months of inventory. So if you think about that from a simple supply and demand standpoint, if a normal market would take 3 to 6 months to sell everything that's out there, and it was at 12 months, there's way too much inventory. So what does that mean in terms of foreclosures? Well, if I'm someone who's beginning a foreclosure proceeding and I needed to get out of my house before that happened, and there's 12 months of inventory, over double what would be considered on the higher side of inventory that's out there, it would be very hard for me to do that. So there's a good chance that I might get stuck into that home, or I'd have to be able to sell it at a place that was so aggressive that it would end up being what they consider a short sale, or I can't pay off the full balance of the loan. How does that compare with today? We're coming out of historically low periods of inventory. And even though the inventory has started to move up, we're still holistically probably at about 3 months. So still on the lower side of what would be considered an average market, and certainly completely different from the 12 months of inventory that we saw back in early 2000s. Now, if I also look at what that means for equity, that gray bar on the left-hand side is the equity that existed back in 2008. So what you can see is it actually was one of the low points historically for the amount of equity in homes. Compare that with where we are, you can see that graph really just firing up on the side. We are at an all-time high for the amount of equity that we have in homes. So what does that mean for us? Well, if I'm somebody who is beginning a foreclosure proceeding and I don't have any equity, and it's probably because there were a lot of common loans in the early 2000s where you were doing zero down. Sometimes you were even doing 110% of the value of the home, and you were doing a lot of interest-only payments. So I wasn't building any equity in homes. Now, if all of a sudden I don't have any equity in my home, and I just showed you on the previous slide that there was a lot of inventory that's out there, I can't afford to sell that at a good discount to get out of the home and avoid the foreclosure. So now all of a sudden I get painted into a corner and I start going down a foreclosure path. If I'm in the market today, especially with all the appreciation that's happened in the last year, and I needed to aggressively price my home with the limited inventory that's still out there, I can get out of that home. So again, avoiding a foreclosure proceeding scenario. Now, I've mentioned all those loans that were going on in the early 2000s. Now, I was a lender back then, and while I didn't give out any bad loans, there were certainly some loans that were given out that put us in a bad spot. So there's actually a chart that shows how hard or easy it is to get a loan. It's called this. It's the Mortgage Availability Index. So you can see that number there at about 1,000. The higher the number, the easier it is to get a loan. The lower the number, the harder. So what you can see there in the early 2000s was the historically easiest time to get a loan. I always joke that you could come in with a handshake and a smile, and I would just hand you a briefcase full of cash. So there were a lot of bad loans that were going on out there. No income, no asset. Stated income, stated asset. A lot of interest-only loans where the only thing we were qualifying people for was to make the interest payment. Well, what happened when it became adjustable in 3 years and 5 years, and all of a sudden it became principal and interest, and your payment doubled? Well, what happened to a lot of people is their payment doubled, They were never qualified to be able to make that payment. So now I need to try to get out of the house because I can't afford it, and I'm going to go down a foreclosure path. Well, I already mentioned that it was a historically low point of equity in homes. So I really couldn't get out of the home at a discount because I already owed too much in the home. And there's a ton of inventory that's out there. So again, I got painted into a corner where all of a sudden I didn't have a choice. We started to see this wave of foreclosures. Now, what you see in the early 2000s is there's a significant drop. It has become a lot harder to get a loan. A lot more qualification standards are in place. So you see that number today is actually hovering around a 108 compared to a 900. Remember, the lower the number, the harder it is. So there's a lot of really responsible loans. So you may have a fixed to adjustable loan that's out there in the market. And for some people, those loans do make sense. But if I look at what I qualify them at, I'm qualifying at a fully adjusted rate to show that they are qualified to make those payments. So I'm putting better loans out there, better qualification standards, better verification standards than existed in the past. So there's a lot more responsible lending that exists today than had existed in the past. So I have better loans. I have less likely scenario that people are going to wind up in a default situation because they couldn't afford it and I put them into a bad loan. Now, the other thing that people were expecting was people had the ability to defer their payments in the last couple of years because of COVID. I personally think that was a great thing. It allowed the market to settle back in. There was a lot of employment that was shut down. But what people were worried about was there was going to be this huge wave of loans that deferred their payments, and it was going to be this wave of foreclosures when all of a sudden they had to start making those payments again. Well, it's interesting. They've actually done some analysis on the performance of those loans as they started coming out of that deferment period in the last 12 months. So I know there's a lot of stats here. Let me sum it up for you. We were worried that it might be, if you said to people, you don't have to make your payment, everyone would accept it. So we were worried it was going to be about 35% of the time that people would have accepted it. It really spiked out about 16 to 17%. But what we're seeing today, and that number now today is under 2%, what we're seeing is the loans that are coming out of that are actually performing very, very well. So people were saying that they wanted to be approved to defer their payments, but a quarter of the time they never actually skipped a payment. So people would say, yes, go ahead and approve me for that because I don't know if I'm going to need it. This market's kind of crazy. I'd rather be approved for it and not need it than not be approved for it and all of a sudden need it. So people would defer their payment, but a quarter of the time they never skipped a payment. So that's a really strong number. A little over 17.5% of the time, people who are coming out of this deferment period are paying off the balance that they owe in full. Now, a lot of investors are doing a great job collaborating with these clients where if you don't want to pay it off in full, you have the ability to re-amortize it into your payments. You have the ability to even modify your loan and extend it at the end. So what does all that mean? It means that we're actually seeing loans that are coming out of this deferred period. Only about 1.6% of the time are they actually starting a foreclosure proceeding. That means 98.4% of the time, it's proving to not be a problem. Why? Because even if I can't afford the payments, again, I mentioned inventory is still in a strong position. I mentioned equity is still in a strong position. I'm in a position that I can get out of that house. So it's putting us into a really strong spot. So really that thought that maybe there was this wave of foreclosures happening as a result of that hasn't really borne out to be true. And lastly, when we look at interest rates, you look at the overall history of where rates have been. Whenever somebody mentions it, you always hear somebody say, my first rate was in the teens. And I know you could see those spiking there in the 80s when they were really high and in the teens. But a number that I like to point out is before the pandemic hit, the rates were actually a little over 5%. That was December of 2019, and they were trending up. It actually looked like they were trying to get into that 6% range by the end of 2020, but then COVID hit. So I've heard people say out there, I just want to wait till rates get back to where they were. Well, if you put it in perspective and you think of what it took to give us the rates the last couple of years, it took an unprecedented global pandemic that basically shut the markets down, the government buying mortgage-backed securities to artificially deflate the rate, and the Fed dropping the prime rate to zero to be able to get it. So if we're looking at that occurring again, I just don't see that it's highly likely. Again, no one knows what the future is going to hold, but that's a lot of extenuating circumstances to get where they're going to get. A phrase that I love people saying as well is, if you think the rates are going to go down, marry the house, date the rate. You can always refinance down the line. So if we want to sum up everything that we looked at out there, the reality is no one really knows what the future is going to hold. You have to continue to go with it. The thing I wanted to give you here today was some ammunition to just look at the facts and the differences between 2008 and today. You can see that 2008 historically was a gigantic anomaly as far as a drop in rates or a drop in value of homes. And it was really driven by the amount of foreclosures that were happening in the market. So if you look at that happening and you look at the key differences between the inventory that's out in the market, the equity that's built up in homes, the differences in lending guidelines that are out there. And again, I mentioned about those forbearance situations where they were deferring the payments and that not coming up. There are some real stark differences between what happened in 2008 and what's happening today. So again, rates are up, still historically strong, but the reality is the right decision is the one you sleep best at night with. Just don't make it based on what you're scared is happening in the market, based on being in an educated decision. If you want to know more about it, if you want to discuss some more details, please reach out to me. My contact information is down below. I'm happy to chat it over with you. My goal is not to talk anybody into anything, but to make sure that you make a great educated decision for you and your family. If you do that, then no matter what decision you make is the right one. Hope everybody is having a great day. Take care out there.